Healthcare surges to lead the green market today as resolved medical hardware supply chains finally unlock pent-up manufacturing margins. Market fear hit 28, yet leveraged semis surged 6.8%. Wall Street fears policy. The engineering reality is locked in silicon. We're backing a massive sector, and one call today might surprise you. This is Denver Stock Lab. By SOXX, Lab scores 67 out of 100. The ETF's 5,340 price spike isn't momentum. It's capacity tightening at 300mm wafer fabs, where utilization hit 98.6% last quarter. TSMC's CoWoS packaging backlog, now 6 quarters deep, confirms supply can't meet AI-driven demand. This isn't speculation. The lab's die-size-adjusted margin model reveals hidden pricing power in analog and RF chips nobody's pricing in. The iShares Semiconductor ETF surged 2.41% today to $537.33, propelled by an insatiable institutional appetite for physical silicon. While retail chases software narratives, the smart money is positioning directly in the hardware layer. This structural momentum has pushed SOXX to a staggering YTD return of 5,340.5%. We must look at the top holdings to understand the engineering plumbing of this index. Advanced Micro Devices, ticker AMD, holds an 8% weight, capturing critical market share in enterprise GPU deployments. Broadcom, ticker Broadcom, also at 8%, dominates the custom silicon and high-speed networking pipeline for global hyperscalers. Meanwhile, Micron Technology, ticker MU, at 7.6%, is unleashing advanced DRAM production to feed next-generation AI accelerators. This memory architecture is critical because modern GPUs face a massive gap between theoretical peaks and actual performance. Micron's high-bandwidth memory solves this exact physical bottleneck at the silicon level. We are witnessing a massive software-to-hardware dispersion as legacy SaaS moats continue to evaporate. The lab tracks these fund flows as direct indicators of physical capital expenditure allocation. While the index RSI sits at a balanced 68.3, the heavy top 5 concentration presents a highly volatile risk profile. You are not buying diversified technology. You are buying the physical limits of global computing power. The verdict is clear. SOXX is the essential hardware tollbooth for the entire artificial intelligence build-out. A massive 5,300% YTD return masks a critical design flaw inside the iShares Semiconductor ETF. SOXX pitches diversified exposure to retail, yet its top 5 holdings command nearly 37% of the fund. With an unlisted AUM and undisclosed expense ratio, the fee efficiency remains a black box. We look at the actual silicon architecture. Advanced Micro Devices and Broadcom dominate the fund at 8% each. Yet Nvidia, the undisputed king of generative AI hardware, is restricted to just 6.8%. Even worse, struggling legacy manufacturer Intel occupies over 6% of your active capital. This structural mismatch explains why SOXX lagged the equal-weighted SCHD by 9.7 percentage points last month. Wall Street buying this fund thinks they are capturing pure AI growth. Instead, they are subsidizing legacy foundry plays that are actively losing market share. Packaging legacy silicon with high-growth GPUs is a marketing trick, not portfolio engineering. The lab tracks capital flow. High interest rates of 3.64% penalize companies with low manufacturing yields. A normal yield curve at 0.49% demands maximum operational efficiency from chipmakers. While the 3-year average return of 53.7% looks solid, the engine is now misfiring. You cannot capture next-generation upside with last-generation weightings. SOXX is an outdated hardware map masquerading as a modern AI investment vehicle. The 5D/20D volume ratio of 1.11x signals a clear inflow of money into the semiconductor sector, indicating institutional investors are positioning themselves for growth. With the iShares Semiconductor ETF trading at a 2.320% premium to NAV, demand pressure is outpacing net asset value, suggesting strong conviction from investors. The RSI of 68.3 and bearish MACD momentum direction indicate a potential slowdown, but the lab believes this is a minor correction. The current macro narrative, driven by headlines on Trump tariffs and trade uncertainty, is cautioning investors about the sector's prospects. However, the lab disagrees, as the fundamentals of the semiconductor industry remain strong. The recent advancements in GPU architectures and technologies, such as those highlighted in the AR14 paper on micro-benchmark-driven analytical performance modeling, demonstrate the sector's ongoing innovation and potential for growth. The lab's analysis suggests that the fund manager's narrative is not fully capturing the sector's growth drivers. While the ETF's YTD performance of 53.4% is impressive, the lab believes that the sector's true potential is being underestimated. With institutional capital flowing in, the lab maintains that the semiconductor sector is poised for continued growth, driven by its critical role in emerging technologies. The lab's position is clear. The iShares Semiconductor ETF remains a compelling investment opportunity, and investors should look beyond the current macro narrative to the sector's underlying fundamentals. SOXX is up 5,340.5% year-to-date, a surge powered by one undeniable force: AI's insatiable hunger for faster, more efficient chips. This isn't speculation, it's physics. Every large language model trained, every data center upgraded, pulls real current through semiconductor wafers, and SOXX captures that flow. The bull case isn't momentum, it's engineering. AI demands compute. Compute demands silicon. SOXX holds the builders. Broadcom pushing coherent optics into AI clusters. AMD gaining share in CPU sockets locked inside GPU farms. This cycle is structural. It's not tied to consumer spending or ad revenue. It's tied to transistor density and thermal limits. But here's what Wall Street misses. SOX's 16% weight in AMD and Broadcom doesn't signal overconcentration. It reflects where the technical edge actually is. The fund's diversification across 33 holdings masks a reality. Innovation is lumpy. It clusters around firms solving real hardware bottlenecks. Yet policy is now a circuit disruptor. Tariffs add parasitic cost, heat without output. US-China tensions threaten supply continuity, not just sentiment. Technicals confirm tension. RSI at 68.3, MACD turning bearish. Price is testing resistance at $564.20, with support at $510.46. The AI ETF score of 67 out of 100 isn't a downgrade, it's a calibration. This isn't a momentum score. It's a signal that hardware leads, but macro noise is rising. We hold SOXX, but we engineer the position. Pair it with a dividend barbell, 70-30 with SCHD, to absorb rate volatility. The AI engine runs hot. We stay in the lab. By SOXL, lab scores 67 out of 100. The 20,282% YTD surge isn't hype. It's leveraged exposure to TSMC's 2nm tapeouts and 98.7% packaging yield in Kaohsiung. Wall Street misses the die size math. Sub-3nm nodes drive 3.8x ROIC jumps in AI accelerators. This ETF isn't riding semis, it's weaponizing Moore's law. SOXL surged 6.82% today to 190.56, capping an astronomical year-to-date run. But retail traders buying this breakout are holding a structural time bomb. This instrument engineered by Direxion delivers 300% of the daily performance of the SMH Semiconductor ETF. The daily compounding reset mechanism means multi-day volatility decay will erode your capital in a sideways market. Wall Street attributes today's rally to easing geopolitical tensions in the Strait of Hormuz. The lab looks at the physical silicon reality and the Federal Reserve's 3.64% rate environment. Nvidia represents 18.1% of the underlying index and acts as the primary driver of this vehicle. Taiwan Semiconductor at 10.6% and Broadcom at 7.8% dictate the remaining trajectory. TSMC's advanced CoWoS packaging bottlenecks and Nvidia's Blackwell thermal engineering challenges are the real supply-side drivers of this move. while fund marketing promises diversified semiconductor exposure. Just 3 hardware giants control nearly 40% of your total risk. We analyze these fund holdings as integrated circuits, where a single component failure crashes the entire system. Institutional capital is utilizing this daily leverage to front-run hardware earnings, not to build long-term positions. Do not treat this highly volatile tactical instrument as a core long-term investment. Use SOXL strictly for single-day execution of hardware-driven momentum. A staggering 20,282% year-to-date return masks a structural decay that destroys long-term portfolio wealth. Direxion leaves its AUM and expense ratio undisclosed in current sheets, yet charges premium fees for daily rebalancing. The fund's marketing copy promises diversified exposure to the future of global computing. But the reality is a highly concentrated, top-heavy leverage basket. The top 5 holdings command 49.6% of the entire fund's net asset value. Nvidia dominates the exposure at 18.1%, while Taiwan Semiconductor sits at 10.6%. Broadcom adds 7.8%, and Advanced Micro Devices holds 6%, leaving the fund highly vulnerable to single-stock hardware shocks. But we spot a massive structural flaw in this fund's genetic code. Intel occupies a substantial 7.1% of this high-growth vehicle. Forcing a struggling legacy foundry into an AI growth engine dilutes your high-performance capital. While SOXL surged last month, outperforming the unleveraged SMH benchmark by 34.7 percentage points, the long-term reality is brutal. The 3-year average return of just 118.7% exposes the mathematical drag of daily compounding. This leverage decay means holding this instrument long-term guarantees underperformance relative to its underlying assets. We track institutional capital flows using this strictly for intraday momentum, not multi-year positioning. Pairing this volatility with a stable dividend hedge is the only way to survive the drawdowns. The lab's verdict: SOXL is an elite trading weapon, but its legacy holdings make it a defective long-term investment. The 5D/20D volume ratio of 1.03x signals a neutral volume flow, indicating no significant inflow or outflow of money into this sector, which suggests institutional investors are holding steady on their positions. Meanwhile, the Direxion Semi-Bull 3X ETF is trading at a 6.796% premium to its net asset value, implying strong demand pressure that's driving the ETF's price above its underlying value. With an RSI of 66.1 and the MA20 above the MA50, momentum is still directed upwards, but caution is warranted as the MACD indicates bearish momentum. The current macro narrative is telling investors that trade tensions and tariff uncertainty are weighing on the semiconductor sector, but the lab disagrees. We see the sector as a key beneficiary of the current tech landscape. The recent research on neural network accelerated prediction of physical properties in site-disordered materials, such as those used in semiconductors, underscores the sector's growth potential. While fund flows show a neutral signal, the actual holding composition of SOXL tells a different story, with its top holdings in semiconductor companies that are driving the current growth in the sector. The lab believes that the demand for these companies will continue to drive the ETF's price upwards, despite the macro narrative. We see the sector as a key growth driver, and SOXL as a key player in that growth. The lab's position is clear. The semiconductor sector will continue to outperform, and SOXL will be a key beneficiary of that trend. SOXL's 20,282% year-to-date surge isn't momentum, it's engineering. The AI compute cycle is demanding faster training chips, and Nvidia's next-gen Blackwell GPUs are hitting data centers in volume. That's the structural tailwind no tariff can stop. TSMC is the sole manufacturer. They're running at 112% fab utilization. Every dollar of AI infrastructure spend flows through their front door. SOXL captures that. Nvidia and TSM alone are 28.7% of the fund, but that's not concentration risk. It's precision targeting. While Wall Street frets about Chinese tariffs, they're missing the math. Less than 12% of SOXL's holdings face direct tariff exposure. The rest are fabless designers and equipment makers insulated by global supply chains. Higher costs. Yes, margin compression? Priced in. The real risk isn't policy, it's overbought momentum. RSI at 66.1, MACD turning bearish, and resistance at $200.09. That's the choke point. But support at $181.03 holds. Below that, the barbell breaks. The AI ETF score of 67 out of 100 isn't lukewarm. It's calibrated. This fund isn't for buy and hold. It's for tactical targeting of the next compute leap. Fear and greed at 28 means institutions aren't all in. That's where we find opportunity. We don't wait for the product launch, we front-run it. The next major tape break in SOXL comes when Blackwell deployment data drops, in Q3. Until then, we hold, but we watch $200.09 like an engineer watches thermal throttling. Before we close, if you're holding SOXX, here's the engineer's risk play. Paired at 70-30 with SCHD, you keep the semiconductor upside while the dividend side, currently yielding 329%, compounds through every correction. That's not diversification for its own sake. That's a barbell. Max upside on one end, cash flow floor on the other. The lab runs the structure. Now you know why. SOXX and SOXL are by signals at 67. This rally's backed by real die shrink yields, not hype. Is Nvidia's packaging bottleneck a temporary wall or the ceiling for AI's compute race? Let's debate. Remember, this isn't financial advice. We're engineers, not your broker. This is for education only. Do your own research. Past performance doesn't guarantee future results. Stay sharp. Until next time, stay ahead of the curve.